Next part is the futures price. This is very short because a futures price is not like option price. Option price is more likely like the pricing of the option itself based on the possible cash flow in the future. The futures pricing is simpler. You can actually have the futures price obviously should be related with the spot price because it's the same commodity. So now suppose you purchase commodity now and store to T, which is the maturity date. Simultaneously, take the short position in futures and see what happened. So next slide, we basically borrow the spot price and buy spots. So initial cash flow, you borrow S and buy spot, right? And you sell futures, you don't make any payment in the right now. And then you hold until T, until maturity date, then you have to pay back this, the amount of borrowing. If you can borrow risk-free rate, then it's gonna be S0 times 1 plus risk-free rate to the TIF. That will be your payment of your loan, right? And then because you buy spots, you have ST. So the price at maturity date, and then sell futures means you are better off if the current price declines, right? Or increases, you have loss. So the payoff from futures will be the futures price minus price at maturity date. This is short position payoff, right? So if you add everything, then this is F0 minus S0 plus 1 plus R F to the TIF should be what? Initial cash flow 0. Which means futures price should be S0 times 1 plus risk-free rate to the TIF. Okay, that should be the futures price with no arbitrary conditions. So that's the proof. So go back to the previous one again. Suppose that the gold currently sells for 1,200 per ounce. If the risk-free interest rate is the 0.1% per month, this monthly rate, 6 months maturity futures contract should have the futures price from the spot futures parity theorem, which is the future price should be spot price times 1 plus risk-free rate to the TIF. In this case, $1,200 times 1 plus 0.1% to the 6, right? It's a monthly rate. Now, which is $1,207.22. Okay. If it is 12-month maturity, then you have to convert this one to 12, T to 12. So it increased to $1,214.48. So that's how to calculate the futures price. So pricing futures is simpler. Doesn't really mean that you always have this futures price, actually, because the futures are always separately traded. So theoretically, this spot futures parity theorem should hold. If not, then you actually have kinds of arbitrary opportunity like this. Obviously, the interest rate may be volatile, may be changing, fluctuates. This is changing variable. So you cannot simply just saying that, well, this is the arbitrary opportunity because this interest rate may change. But if it happened, then you can have arbitrary opportunity if it doesn't hold. So basically, the future price has two factors. One factor is called the spot price. The other factor is called the cost of carry. Cost of carry. Okay. Now, if the cost of carry is huge, then future price will be below the spot price. If the cost carry is a negative, then you have positive, like a more higher futures price than spot price. So there is a term called the cost of carry. Stock index futures pricing example. Suppose the risk-free rate is 0.1% per month. The dividend yield on the stock index is 0.2% per month. So the stock index is currently 1,800. The net cost of carry is therefore negative, right? Because you have 0.1% in risk-free interest, but you have dividend yield 0.2%. So negative 0.1% per month is the negative cost of carry. The 3-month contract, 1,800 times 1 minus 0.1% to the third, so it's below the spot price. So if the, this is cost of carry is the percentage wise, right? So the cost of carry is negative percent, then you have lower value than spot. If index rise to 1,810, then the 3-month futures also rise to 1,810 times 1 minus 0.001 to the third, so to the 1,804.50 cents. 6 months just to change T. So futures price may be valued by spot future price theorems. The relation between these parities, like spot futures parity theorem and this formula. So just remember this formula to get the futures price.